Hi, I'm Keith McCullough. Welcome back. After a week of vacation, I'm getting a lot of questions on what's changed. What do you think after last week? Of course, because the U.S. stock market was up, albeit on no volume last week. People rightly want to know. And what I'll tell you is that nothing has changed, particularly in terms of the big stuff. And what I really mean by that are the global macro themes that we've been running with here at Hedgeye for the year to date. Number one would be inflation accelerating. We've been making that call, obviously, since January. And number two, what gets infected by inflation accelerating, which is, of course, the U.S. consumer slowing. So those are the two big themes. Again, if anything last week, the consumer most likely slowed faster because inflation continued to go higher and the rally in inflation was much more broad-based, which included, by the way, oil last week. But first, I want to tell you how to be long that. Because when I say that the consumer is going to slow, people are typically going to say, oh my God, growth is slowing, I need to get out. No, no, no. What you need to do is you need to get out of high-flying biotech and social media stocks, and you need to be buying inflation. So that would be the first thing. Buy inflation explicitly. You can do that via commodities. We're showing some ETFs here, which would include the ag index in and of itself, natural gas, coffee, etc. The second thing that you can do to be long inflation is to buy protection. So again, buy Treasury inflation protection via TIPS. We've liked that for quite some time here, at least for the year to date. And then finally, you can buy the link that is what happens when inflation slows growth, which is, of course, buying bonds. Now, traditionals, I guess, would say you don't buy bonds when inflation's going up. No, 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 no. Not in this environment, because the Fed has 0%, not only as a policy, but credibility on fighting inflation. In fact, the Fed last week said that they want to see more inflation. So again, they need more. They're going to give you more. And the more inflation you get, the more bonds are going to go up because growth's going to slow faster. So again, keep that in the back of your mind. Now, just to wrap all this up, just in terms of the actual inflation in the market, as opposed to what the Fed's telling you that they're seeing, let's just look at some of the big stuff. Number one, the CRB Food Index. Again, CRB Food Index up another 2.7% last week. It beat the S&P 500 again, even on the week. For the year to date, get this, it's up 21.6% for the year to date. Now, if you don't think that that matters, listen to the Chipotle conference call where the stock went straight down when they told you that in their cost structure that matters. Not only does it matter in the cost structure of somebody who's manufacturing the burrito, but it matters to those people who are buying the burrito. So again, think about this. Just think about it from a common sense perspective. Throw out all that Keynesian economic crack that people are smoking. Second point, coffee. A lot of you drink coffee. I bet you that. Up 77% now for the year to date. Wow. I mean, soy, which you might put in there, up 18, 19% now for the year to date after having a big week last week. And then finally, natural gas up 2.6% on the week. In spite of the weather, don't forget we had great weather in many parts of the country last week. Natural gas up to 15.8% for the year to date, and we obviously have that position on the long side of real-time alerts, and we have coffee and things of that nature too. So that's that. If you think about the themes, you're going to get this year right. The Dow's down, the Nasdaq's down, social media stocks are imploding, but if you're long inflation and you're long bonds and you're long slow growth, you are crushing it. So if you have any questions on that, please ping me. I'm at Keith McCullough. That's my Twitter handle.